be fair, I mean, Chinese stocks are off to their worst start in a decade.
Well, there's a lot we have to unpack, Haslinda. First of all, thank you very much for having me on. It's a pleasure to be here. But the word uninvestable is, I think it's not very helpful because this is a roughly 10 trillion market cap market overall, if you take the A shares, the H and the ADRs. And it trades about $150 billion a day. So the idea that it's uninvestable is kind of a sweeping statement. So I think that's not terribly helpful, frankly, way to characterize things. I think it's probably better and more insightful to say that it's very challenging and complicated to invest in China. And it seems to us from the data we look at that the constituents who are investing, the people who are investing in China, that constituency is shifting. So it's very clear that U.S. investors have decumulated, disinvested, some of that being intensified or required by government edict, if you would. Texas and I believe one other state have actually just issued proclamation saying that public pension funds cannot invest in China. So, there's either a legal or a strong overarching effort to reduce the amount of U.S. investment that's going on in China. Having said that, if you look, for example, at Southbound Connect flows into Hong Kong, and just to remind your viewers that Southbound Connect is mainland Chinese money coming into the Hong Kong stock market, the amount of flows that came in 2024, last year, was over $100 billion US dollars. So Chinese investors are buying, quote, their own market. So I think that one of the themes that we're seeing is a shift in leadership and ownership from foreign investors, particularly U.S. ones, which is obviously informed in part by geopolitical tension and so forth, which we can get into in our conversation, to more domestic investors. The other point I think is very important to emphasize is that the requirement for China to do well, and what our assumption is, but it's very much the critical ingredient in our tactically constructive view on China equities, is that government policy does come through. Now, we think it will do. We can unpack more of that in our conversation, I'm sure. But as sort of an opening observation, I would say that you've got this shift in ownership of Chinese equities and the requirement for equities to resume their upward move, which we saw a very powerful move in September and October, and we've corrected about half to 60% of that. To get to sort of stabilize here and move further up, we're going to need clear and more tangible evidence of policy support.
You talked about how the national team has been boosting Chinese stocks. We're talking about what, I think 6% of the valuation of Chinese stocks as a whole. I'm just wondering whether that is good enough for you to make an overweight call in Chinese stocks.
So it's not dependent on the national team. A national team sort of comes in at times of particular stress and will sort of form a bottom in the market, or a short-term bottom in the market. I think what's required here is further evidence of Chinese policymakers implementing the so-called Beijing put, the idea that they want to take out the so-called left-tailed risk, the downside risk in growth. We think that clearly happened with the September 24th set of policy measures. That was when the PBOC and the CSRC and the National Finance Regulatory Authority, those are the three key monetary bodies, they had a joint press conference, as you may recall, which basically really signaled the shift in the market. That was quickly followed by a succession of other press conferences showing that there really was a policy pivot. I think that was enough to get the market going. In fact, it was a rally of nearly 50%. But we need now to see further evidence of the implementation of that. Now, we do expect that. We think that monetary policy would turn more accommodative. That we're expecting two 20 basis point cuts in interest rates. We're expecting two 50 basis point cuts in the reserve ratio. We think there will be a significant increase in fiscal support. The broadest measure of fiscal is what we call the augmented fiscal deficit. That's both the central government deficit plus the more broad provincial deficits. We think that will increase close to 2% of GDP this year, which is significant. So we think there are efforts to support growth. And if that happens in the context of a market which, as of last night's close, was trading at 9.7 times forward earnings, and where positioning is still light, we think that the combination of that could get China to go back up this year.
But the thing is, all the stimulus measures that you've announced are pretty much factored in. That's why we saw the Chinese stocks gaining at the end of 2024. How much more upside can you expect?
Well, I say yes and no. To just get some numbers on this, so the trough of the market was September 11th, and we had, as I said, about a 50% rally, close there too, into the second week of October. Since then, we've given back about half of that, or a little bit more. So put that in valuation terms, we went from just below from 9 times earnings to 11 times earnings. And we've now corrected, as I said, back to sort of just under 10 times earnings. For a variety of reasons, which we've articulated in our research, we think that 11 times earnings is roughly what we think would be, quote unquote, fair value for China in the context of the macro and political and policy and so forth environment that we're expecting. So if indeed China comes through with the policy support, could you get a moderate recovery in valuation from, in round numbers, 10 to 11 times? And then as you go through time, you can also have some underlying earnings accretion, which we think will be sort of high single-digit earnings growth. If you put those together, about a 10% valuation expansion and about 8 to 10% earnings growth, that could get you high teens type of return. And we've seen that China can do that in like a week if the sentiment turns. So, you know, I agree that China is very difficult to invest in. And one additional point that's maybe helpful for your viewers is that many global investors that we speak with have really, disinvested or just said, look, China's not worth it for me. I actually have a fair amount of sympathy for that, or I can understand why they have that view, because if the global market is your playing field, so to speak, and China now is only about 2.5% of the global ACWI, all-country world index. U.S. is 65%, thereabouts.
Biden saying no to Nippon Steel buying U.S. steel. It is about national security. You got to wonder what it means for deals generally going forward, and also what it means for investor sentiment.
So it depends on which deals we're talking about. If it's cross-market or within market, et cetera. Maybe I just step up a level here and just summarize our view on Japan, because we're constructive. It's probably one of our strongest views. And I think the key concept is that, at least with the recent investor conversations we've had after we put out all our 2025 year ahead views, we had a lot of meetings with investors globally, both me and my colleagues. And I think there's a general appreciation of the positive investment case for Japan, which I'll articulate quickly in a moment. But the evidence is clearly that foreign investors have actually decumulated from Japan and that their holdings are quite light. So the key concept here, Haslinda, is that there's a sort of positive investment gap between where people's minds are at versus where their wallets are at, so to speak. And so we think that can be closed in a positive direction with more buying coming into the market and driving Japan to further highs. And we think new highs are in store. Why is that the case? Super quick, the weakness in the yen roughly translates every 10 point move in the US dollar Japanese yen rate on an annual basis basically improves earnings by about 4%. So if we've got a weak yen, we still think we're in a strong dollar environment. That should result in some better earnings. So we think earnings will grow roughly around 9% this year next. Market's trading about 14 times earnings. It was trading well above 15 at the peak last July. So we think we can still recover some of that multiple correction. So if you put the underlying earnings along with a bit of valuation recovery and some underlying buying by foreigners, we think we can get sort of mid-teen returns for a large and liquid market, which has many interesting investment themes within it, which would include, not to enumerate all of them, but at least one or two of them would be obviously one, the BOJ normalization. That's going to be good for banks if you steepen the yield curve and so forth. Two, we were talking about geopolitics before and so forth. We think the theme of defense spending across Asia, but also very much in Japan itself, is a really viable and good theme. And then number three, you do have some domestic reflation, which is taking place. Nominal GDP, we think, will grow about 3% in Japan this year. And so that should be better for some of the consumer stocks. So we've got a number of themes. I just would mention those three.
Let's discuss the Indian equity outlook. I mean, do you think it'll find its mojo in 2025?
Yeah. Well, we're hoping. We sort of thought it was going to go mojo light for a while, so to speak, which is that we've had a very constructive view in India, which I know is not out of consensus, but it certainly was very clear that India, in our view, and I think in many other investors' views, is arguably the best longer-term structural growth story in Asia. In fact, probably in all emerging markets of any market of really significant size. and depth. Now that being said, and as you just mentioned, the market did very, very well again last year into the first 3 quarters and actually into the peak in early October. And we downgraded our view for 2 key reasons at that point. Again, sort of on a tactical basis. The first was that valuations had gotten up to 25 times forward earnings, which is sort of the peak in terms of absolute relative to the region and so forth. Just market had priced a lot of good news in. And secondly, we were pretty clear that both from an economic perspective as well as a corporate earnings perspective, that we would have what we call a mid-cycle slowdown. And in fact, if you look at the economic data which has come out, where India had sort of the worst quarter in the 4th quarter calendar year that it's had in a long time, it's a bit over 5% on a year-on-year basis. And then also if you look at the earnings delivery, that was missed consensus by a lot. So, clearly there's some sort of slowing which is taking place. It's nothing to get sort of super worried about because India was going so hot, it's naturally going to correct. But we just think the market needed some time to digest, these developments. So we sort of said, look, let's step away from an active, constructive view and just bide our time. So the question now is, when do you want to re-engage? Because we think people should be, with that mind frame of re-engaging in this longer-term story. And really, it's going to be a function of when the growth kind of stabilizes and starts to improve again, which we think will take place maybe in the second half of this year. And then secondly, the extent to which the market has discounted that. So either, if the market goes down a lot more, we'd be more inclined to improve our view, or maybe you need a little bit more time for the earnings to catch up with valuations if the market's range trading, in which case your re-entry point might be sometime later in the 2nd quarter. But I think the message for investors is, identify the stocks that you like, the themes that you like, and put your toe back in the water when you think the prices are reasonable.
Are you concerned about the slowdown in growth? Some say that it will continue to head that way.
So you always want to be humble in your views, right? Because if anything, we've both been around markets for a while, and markets have a wonderful way of challenging your strongest conviction views. And so I think we have to have a strong dose of humility in terms of unexpected things that can happen. And to your question, it's clear that there could be challenges to growth in a number of different areas. But our core fundamental view is that if you look sort of at the so-called Cobb-Douglas production function, which is labor, capital, and total factor of productivity, labor, India still has a demographic dividend. There still is lots of investment which is taking place, and productivity still has a long way to go. So India's underlying growth potential, we think, is clearly in the mid-6% potential, sort of goal 6.5% for the next 5 years, maybe the next 10 years. And the good thing in the Indian market, and this is in positive contrast to China, is that corporate India, empirically and over the last 20 years, has done a much better job of monetizing the economic growth environment and delivering earnings to investors than Chinese companies have. There's a whole bunch of reasons for that, which I won't go into, but the key takeaway is that corporate India really has delivered the goods. So assuming that we can get back to kind of roughly mid-teens earnings growth, which is pretty good in terms of what your global comparables are, as long as you're not paying too much for that, that still seems to us to be a pretty good risk-reward opportunity.